Hello everyone. Federal Reserve just announced another 75 basis points hike. Can this relentless Fed's push to raise interest rates lead to a systemic shock and have a domino effect throughout the entire global financial system? To answer this question, let's take a look at the recent massive loss at Swiss National Bank. The Swiss National Bank, SNB, lost a staggering $142 billion in the first 9 months of 2022, as rising interest rates and the stronger Swiss franc slashed the value of the central bank's foreign investments. The loss, the largest in the SNB's 115-year history, was slightly more than the annual economic output of Morocco, Reuters reported. This news came out on the heels of Credit Suisse troubles and mysterious $9 billion swap line. This story is kind of unique. Not every day we hear about effects of widening financial crisis on central banks themselves. We are hearing a lot about the role central banks have had in bringing about the era of rampant inflation, but there is another side to this story. Central banks, despite their role as a safety net to backstop financial crises, can be a hazard to the system themselves. So how central banking can create hazard for entire financial system? Let's take a look at results of central banks' interventions of the past couple of decades. Directly from the source. The Central Bank of Central Banks, BIS, Bank of International Settlements. Here is assessment by Markets Committee Working Group, called Market Dysfunction and Central Bank Tools, published in May 2022. Interventions to address market dysfunction are not without cost, and may expose the economic and financial system, central banks and government resources, to a range of risks. First off, BIS is clearly stating that they are fully aware of consequences, or costs, as they put it. You can't just print unlimited money, to paper over structural problems, and have no consequences. As you would expect, media is trying to put a positive spin on a bad situation. Here is a take pushed by Reuters. Central bank does not face bankruptcy, thanks to its ability to create money. But what about other consequences? Switzerland is unique as to why they had to resort to interventions. Most Western countries print money to deal with budget deficits. Swiss central bank had to intervene to weaken its currency by buying US dollars, creating massive dollar reserves. Too much money can also be a problem after all. I don't want to go into the details to keep this video short, but regardless of the reasons, the problem, as with the rest of the Western world, is that instead of solving underlying issues, governments use quick fixes with central banks' interventions, instead of structural reforms. No buyers for UK bonds, central bank unlimited QE. Excessively strong Swiss franc, print more francs and buy US dollar and so forth. Result is the same, misallocations and distortions, that, if unchecked, might lead to complete collapse. This is true, central bank can't go bankrupt, since they can just open up a computer and add few zeros the central bank balance sheet. But what about currency devaluation or, to put it slightly differently, inflation? Can this be a systemic risk? Yes, it can, and it is. Just look at example of US Federal Reserve trying to raise rates into an over-leveraged economy, while wrecking the rest of the world. This is major systemic risk. Granted, actions of the Swiss National Bank will not have the same ramifications for the world as US Feds. But you can be sure that Credit Suisse's problems are mostly tied to central banks' interventions of the last 2 decades. With negative interest rates, individual players, like banks, hedge funds, pension plans and others major systemically important participants, venture into more and more leveraged and risky derivative markets, inflating derivative market into quadrillion-dollar neighborhood. Can quadrillion-dollar bubble, backed by just a few $1 trillion of underlying assets, be a systemic risk? Surely can. Need for a swap lines to other central banks clearly illustrate this problem. Look at pension problems in UK. It almost collapsed UK's bond market. Borrowing, using short-term instruments on margin to buy long-term bonds in attempt to squeeze minuscule profit from arbitrage at a cost of taking huge risk, is a direct result of central bank interventions. Can anyone with certainty rule out a possibility that US financial entities were engaged in these risky derivative schemes? Probably not. Can it create the same fallout and risks here in US? Very likely. As BIS report summarizes, an over-reliance on central bank interventions risks distorting market mechanisms and incentives as it can give rise to an underpricing of risk. There you have it directly from central bank's governing body. As we can see, policies of central banks can create, and do create systemic risks for the entire financial system, especially when these policies reversed. But what about effects of losses of central banks on functioning of the financial system? Again, Switzerland is unique. During its interventions to weaken franc, it accumulated major reserves and deployed them into US bond and stock markets. Normally, this would be a safe option, that worked perfect with US bonds and stocks moving in a positive direction. But as we all know, last couple of years, US stock and bond market, just like European markets, were moving from one crisis to another, wiping out investors' equity along the way. Basically, what you have seen in UK bond market is happening to the assets of Switzerland. According to Reuters, the SNB made a loss of 141 billion francs from its foreign currency positions as the bonds and stocks bought during its campaign to stem the appreciation of the safe haven franc slid in value. The figure included exchange rate related losses of 24 billion, as the stronger franc further reduced the value of its holdings, which include stakes in coffee retailer Starbucks and Google's owner, Alphabet. Different derivatives, same outcome, massive losses. UK was hit by bond market derivatives, Switzerland was mauled by currency-related derivatives. Can central bank loss cause a financial collapse on a national level? Aside from currency devaluation, probably not. The loss will be passed on taxpayers without anyone voting or agreeing. Here is another passage from BIS statement. Interventions may also pose risks to central bank capital and taxpayers' funds. Bigger sovereign debt is a problem, but, if serviceable, is not an end of the financial world. But when it comes to liquidity, central bank losses can be a huge problem. News about $9 billion swap lines for Swiss National Bank were generally attributed to the problems with Credit Suisse. But after disclosure of massive losses at Swiss National Bank, I suspect it could have been drawn to support liquidity of the Swiss central bank itself. Loss of liquidity for central bank will affect currency operations, payments between credit institutions and so forth. But it only happened to Swiss National Bank, right? No official losses were reported by any other major central bank. Let's dig a bit deeper. US Treasury website shows almost 300 billion worth of US Treasury securities held by Swiss National Bank. We do not have an exact breakdown of maturities, but we can safely assume that massive loss of Swiss National Bank was, in part, due to losses on US bond and stock markets. But what about the rest of the US bond holders? Did they also sustain massive losses? UK's, Chinese and Japanese holdings are twice or more the size of Swiss National Bank and as a consequence, should have caused much bigger losses. Can it be one of the reasons behind UK's sovereign crisis that no one is talking about? What about losses of Federal Reserve that has a balance sheet in trillions? Can those losses create a system-wide crisis globally? I will leave this question up to you. Let me know in the comments if you see a problem here. Please subscribe if you would like to see more videos like this. Thank you for watching, until next time.